Well, good afternoon, everyone. Thanks very much, Ray. I'm delighted to be here, back with old friends. And I want to thank you and Pricewaterhouse and FBA for scheduling this and sponsoring this meeting. I would have thought at least we could have had the market up today, but we weren't able to arrange that. At any rate, the lessons learned from the current financial crisis is a rather challenging title, to say the least. It's premature, perhaps, since we are, in my view, only in the early innings of what could be a protracted period of economic stress. And there will be inevitably even greater lessons to be learned from the events that have yet to transpire. Hopefully, we as a nation will have the judgment and the will to understand and act upon those lessons that are yet to come down the pike. However, let me begin with a few comments on the learning process, at least for me to date. And then I'll move, if you will, to a Q&A period where I'd be glad to share observations with all the talent that's in the room here today. I think it's safe to say the current period of economic stress is the most severe challenge since the crash of 1929 and the period which followed. A period that began with that market crash and ensuing depression, 9 years of high unemployment, bank failures, and misplaced government actions that exacerbated the difficulties of the period. In short, I believe we are in the early stages of what I would term a perfect economic storm. Whether it leads to a long recession or an even more serious downturn, or just the opposite, a period of high inflation, remains to be seen. We'll talk more about this as we go on. One is struck by the apparent suddenness of the storm. Was there no warning? I'm reminded of the 1937 catastrophe, of the sudden explosion and complete destruction of the famed state-of-the-art, lighter-than-air dirigible, the Hindenburg. In front of a startled crowd who was there to see this state-of-the-art air machine. It was the most technologically advanced new flying machine of the age. It was destroyed in a moment, to the horror of, and without warning. There were no indications of possible mechanical or structural failure that should have given early warning if assessed before the hand. Were there any? I think not. When my analogy is likened to our current economic stress crisis, the answer, of course, is yes. There were signs which appeared in the decade of the 1990s of impending economic trouble. The first tremor actually was the 9/11 shock. Tragically, one of the first indications of stress came not from business or the financial world, but from a totally unexpected terrorist attack on 9/11. The unbelievable act of terrorism was inspired not just by religious fanaticism, but also was not completely unrelated to disparity in global wealth. It was an attack that had tremendous implications for the financial burdens which we bear today. The first real business-related tremor, i.e. the bursting of the dot-com speculative bubble, the overexpansion of new telecommunications technology with the excessive capital spending boom, which turned out to be in itself a bubble. At that period of time, the bull market that we've been having evaporated, just like the Hindenburg. 75% decline in the NASDAQ stock market in the face of the bursting of those two bubbles. With the markets then leading the economy down, the Federal Reserve sought to stave off recession with drastic interest rate cuts. A second tremor appeared with the exposure of Enron and WorldCom and the corporate fraud of those involved with those two companies. The gross malfeasance accounting manipulation, and failure of corporate governance. I think most of you who are in the securities business are familiar with the earnings per share game that was pursued not just by Enron or WorldCom, but a general laxity, in my view, throughout much of corporate America, where the game was when the financial vice president came in and said that we earned 50 cents this quarter, but the street's only looking for 45, so why don't we take 5 cents and put it in a cookie jar, and we'll bring it out when we need it. Not exactly the fraud of WorldCom, but an indication of an attitude toward accounting and toward reputable behavior. Investor confidence and public confidence just plummeted. Sarbanes-Oxley, the governance reform, was the most important securities legislation since the 1930s, passed almost unopposed by a Congress that was responding to overwhelming public and investor anger and outrage. During this period, the SEC sought to implement rules dictated by SOX, exercised new powers to find miscreants, created a new agency, PCAOB, the Public Company Accounting Oversight Board, which was legislated by Sarbanes-Oxley. Basically, a new oversight entity for the accounting profession, which up until that time had been self-regulated. The leverage, basically, that new misdemeanors appeared shortly thereafter in the largest financial industry devoted to managing public savings, the mutual fund industry. And the so-called late trading and market timing issues were illegal and manipulative acts, and they were perpetrated, as it turned out, by some of this country's oldest and most revered mutual fund companies. Rather shocking. The economic downturn was met by unrelenting efforts of the Federal Reserve to lower interest rates to avoid the escalating economic slowdown. As these extreme monetary stimulus gathered steam, the economy was flooded with dollars available at very low interest rates. It gave impetus to excessive borrowing, to excessive leverage, against the backdrop of a U.S. consumer savings rate of nearly 0. Leverage centered, as you all know, in the housing market, where growth and escalation of housing prices encouraged extreme borrowing and refinancing. The use of the home as it went up in price, refinancing of the mortgage, taking the money out, and stimulating buying. And that gave impetus through the years that resulted in the troubles that we have right now. It gave way to the next steps in financial instrument creation. The first was securitization. And the so-called CMOs and CDOs. Basically, these were new instruments in which the issuers of mortgages put a parcel of mortgages, a number of mortgages in one pile inside a corporate shell, and then sold it as an instrument that had, because of the ratings that it got, sold and gave yields that were much higher and much closer to what you could get in a safer security. That securitization had another effect, which was that the banks and the mortgage brokers, once they packaged up the mortgages that they were issuing and floated them out to sea, if you will, to buyers, were able to go back and start all over again and issue new mortgages. But that took the responsibility for the borrower and the borrower's soundness and ability to pay away from them. Once they got rid of those mortgages and sold them, they had no incentive to really check on the credit rating of the borrower. And that degenerated into the so-called subprime mortgage flood, if you will, where people didn't even have to sign a letter saying what their salary was or demonstrate any sort of the traditional controls that we have. They just walked in there and got a mortgage, and as the price of the house went up, the mortgage got bigger, and many of these houses were financed 100% with mortgages by people who didn't have an iota of chance of being able to pay that mortgage off, particularly when the mortgages were sold with variable rate, so-called ARMs tours with terms, which looked very attractive at the purchase date, but very quickly escalated to even more impossible to pay off. That gave way to the next step in financial instrument creation. And basically, that was the derivative instrument, which derived its value from traditional securities. And it's a word that you've heard quite often now. It's the most toxic of instruments. It's the so-called credit default swap. It's like a neutron bomb. And to not get too technical on this, basically this is an instrument that was sold as insurance against the default of these consolidated instruments that were out there. And that credit default swap was issued by many people. One of the largest issuers of those was the largest insurance company in the United States, AIG. And as a matter of fact, the game got so fast and furious that the latest in the credit default swaps was synthetic securitization, where there actually was no house at all, no mortgage, but simply a default swap against a theoretical phantom mortgage. That went along fine until the bubble broke. And they had lots of very talented academics with great big computers who proposed to tell the issuer exactly how much money they should charge for the credit default swap. And that was the most sophisticated of computer-driven analysis of what the probabilities would be for a default, and then the rate was based on that. What they failed to analyze, in my view, was the collateral damage. It wasn't necessary for the instrument to default. All that was necessary for trouble to come was the price of that mortgage instrument to go down. And as the price of the mortgage instrument went down, the person or institution that had bought the swap wanted collateral. And the farther down the instrument went, the more collateral the owner of the swap required. And that's basically what you've been seeing, and we've all been seeing in recent times. You had a $300,000 home with a $250,000 mortgage, or perhaps even a $300,000 mortgage. Suddenly, home prices began to deteriorate. The $300,000 home was only worth $200,000, yet it had a $250,000 mortgage. So the owner if he had or she had any equity, that equity was wiped out, and they were underwater. They had a mortgage that was worth more than the house. And you hear all sorts of estimates on how many millions of people are stuck in this situation, and how many millions of people are on the edge of either being repossessed or just walking away from the mortgage. Peculiar type of instrument in this country where there's no recourse beyond the mortgage itself to somebody that takes out a mortgage. So if you fail or walk away from your mortgage, you can't get at your assets. You lose your house, that's all. So it's much simpler for a lot of people these days to simply walk away from their homes, and at great cost, I might add, to those that hold the mortgage, because now you have an unoccupied home, and great tracts of unoccupied homes, and very soon they become slums, and very soon that $200,000 value is down to $100,000 or less. As I say, the instrument backfired on those that sold these swaps. And then we know, everybody in this room knows the next chapter, which was the unheard of. Bear Stearns, one of the venerable old firms, was sold under stress to J.P. Morgan. Merrill Lynch was acquired under duress by the Bank of America. I never thought I would live to see the Thundering Herd, part of the Bank of America. Lehman, the largest seller of CMOs and purchasers of credit default swaps, went bankrupt. And AIG, the largest insurance company in the world, became the largest seller of credit default swaps and was taken over by the government, and at last count has been the recipient of $150 billion of federal rescue dollars. Concurrent with all this was an escalating credit freeze, subjected finally to a government $750 billion bailout plan. I might add that there were several false starts. We started with a 3-page plan delivered to Congress by the Treasury, which said we want $700 billion. We don't want anybody to look over our shoulder. We don't want any restraints, and we'll take care of it. That's basically what that said. Well, you can imagine what the furor that arose in Congress when that was presented, and that resulted in about 10 days of angry wrangling and so forth, and prevented the Congress from thinking about some other approach to this other than buying bad securities that were held by these firms. And finally, a direction was shown to us by our friends in the United Kingdom, where they had sat back and they figured out correctly, in my view, that the way to begin to solve this problem was not to buy the bad instruments in an auction kind of situation, or if you paid too much, you'd be helping the banks too much. If you paid too little, you wouldn't be helping them at all. But rather putting that money into the equity of the banks across the country. And by doing that, you gave the bank the equity that it could once again start to lend money on. Now, that in theory has been a very good idea. However, we all are dealing with trying to understand what the terms of this potential $700 billion worth of our money going into the private banking system. And there's been a great deal of opacity, if that's a word, opaqueness, in terms of the terms of the deal. And we hear now, but we don't really know, that the banks are sitting on that money. They're not lending it out. The banks are saving that money to protect themselves. I think they look with great favor on acquisitions that they could make with the money. So one has to assume that there were no terms there. There were no terms that said you have to use this money for what it's intended. And I would say that one of the things that is distressing, certainly to me and I think to the whole financial community, is the opaqueness of this whole operation. I mean, not only the lack of supervision, but the lack of knowing exactly what's going on. And of course, Secretary of the Treasury announced 2 weeks ago that they were reversing the program that was set. That the $700 billion was given to buy toxic instruments from banking institutions, and it was announced as a total change in course that now we're going to put it into the equity of the banks. And that, of course, I think was the right decision, but it didn't exactly bring forth too much confidence. Although the credit crunch has begun to thaw, if you will, slowly, very slowly, and it took a lot more to get that going. The government had to guarantee all the deposits and money market funds, for instance. The credit is thawing a bit. However, the secondary effects now of the credit crunch, literally impossible even for the best credits to borrow money. Large companies in this country were unable to borrow, unable to get new lines of credit. And so this started to trigger off the recession. I don't even hesitate to say recession. I mean, people have been talking for months about maybe we're in a recession, and they're talking about the definition of a recession, 2 back-to-back quarters of negative growth. Well, we've been in by that measure, we haven't been in a recession yet. But by any other measure, which is what's happening in the street, we've been in a recession, and a seriously escalating recession for a number of months. I won't bore you with all the statistics, but the consumer spending is down precipitously entering into the Christmas holiday season. Automobile sales, as you know, are down or almost non-existent. General Motors is sitting there on the precipice of bankruptcy. Credit card debt is escalating. Delinquent credit card debt is escalating. And of course, unemployment is growing at a very rapid rate. All the numbers on these statistics are really trailing numbers. Unemployment now is basically about 6.1 to 2%, and I suspect that we'll have unemployment up in the 8 range before we get through this whole thing. Numbers were just out today for October, and they're up by, I forget the number, but I think up by 0.3 or 0.4 of a point versus what everybody was looking for was 1/10. So the unemployment rate is increasing. Meanwhile, the investment banks have fled into the protective cover of being bank holding companies for the simple reason of gaining access to the Fed discount window. As a bank holding company, they now qualify to borrow from the Federal Reserve, which they will be doing in spades. And so we have almost overnight the disappearance of 5 major investment banking firms. And it's the heart of the investment banking industry. It's no longer an investment banking industry, it's inside a bank. And that has major implications, I think, long haul for the availability of capital, and more importantly, from the point of view of people in Wall Street, the profitability of those firms under the more restrictive aspects of being a part of a bank holding company. As I say, the unemployment figure is going up, I think headed to 8% or worse. And as of today, the Dow Jones average is within a hair of being off 50%. Dow Jones, 30 of the largest companies in America, off 50%. Now, such is the circumstance we confront today. However, this is not bad enough. in terms of increasing floods of government rescue dollars coming over the horizon, gigantic new mountain of financial obligations are coming down the pike. The unfunded liabilities of our Social Security system and Medicare and Medicaid, the present value of the obligations that all of us have, according to a man who I believe is the greatest expert on this, which is Dave Walker, who is head of the GAO, the government. He was the government's accountant. Now is with Pete Peterson and his new institute. But according to Walker's estimates, the present value is $57 trillion. $57 trillion that we've committed to pay. That's totally unfunded. To put a little perspective on that, that's roughly $425,000 per individual household in the country. $425,000. The average price of a home in this country is $225,000. That's the median home price. And the average median income is $45,000. So you can see the burdens that face us, on top of what will surely be $1 trillion deficit in the year we're in now, and perhaps a multiple of that before we get done with the bailout. What does this mean? What else is going on? I could sit up here and I'll just comment on a couple of things. We continue to have this short-term mentality in too many of our companies. Earnings per share, quarterly earnings achieved at the sacrifice of long-term investment. We're in a period of massive globalization. Few figures. All the imports and exports from the United States to other countries was less than $500 billion in 1981. The total of in and out of the United States, $500 billion in 1981. Today it's $3 trillion. Less than 10 years, grown at 5 times. The American holdings of foreign securities at the end of 2007 was $6.5 trillion. At the same time, foreign private holdings of U.S. securities, not counting U.S. government bonds, total over $6 trillion. So the U.S. ownership of foreign securities and foreign ownership of U.S. securities add up to a figure that the exact number of the GDP of the United States. There's been an explosive growth of housing, but it's not just in the United States. It's not just the United States phenomenon. An interesting statistic, Spain built more homes in the last 10 years than Britain, France, and Germany together. So when we hear that all of this emanated from the United States, there's a lot going on in the rest of the world. To return to the central question, what have we learned? We've come to understand, I believe, the inadequacy of our current regulatory structures. After the 1929 crash, the Securities Acts of 33 and 34 were passed. The SEC itself was established, and the Glass-Steagall Act was passed, which separated investment banking from commercial banking. This was where a lot of the trouble in the late 20s came from the mixing up of being underwriters and being deposit institutions. So Glass-Steagall caused a separation, and the oversight of regulation for the banks was assigned to the Federal Reserve, and the responsibility for investor protection was assigned to the SEC. Two very different missions, if you will. The bank oversight by the Federal Reserve is prudential oversight. The interest of the Federal Reserve is in the banking system. When they go into a bank, if they find some sort of malfeasance, they quietly settle it behind the scenes, that they have no concern, no license, if you will, to be concerned about the customers, let's say the equities that are being bought by the bank. The SEC, on the other hand, is basically a law enforcement organization with a total mission of protecting investors, individuals and institutions with considerable powers. But what happened is along comes in 1999 the Graham-Leach-Bliley Act, which in effect nullified Glass-Steagall and allowed everybody to get into everybody else's business. So all of a sudden, from 1999 on, we have the banks in the brokerage business, the banks in the insurance business, et cetera, et cetera, et cetera. Everybody's in everybody else's business, and it's stimulated an ever-escalating number of new entities and investment vehicles, hedge funds, private equity funds, all of them out of reach of the regulators. We have the system of responsibility, and yet we have these new financial institutions who are in a hole in our regulatory coverage. And basically, the mortgage fiasco was partially due to the fact that mortgages were not regulated by anybody. You just go out and give them mortgage. No record. Okay, so we also had a breakdown of corporate governance, as I say, the short-term mentality, the explosion of cross-border global investing, and the clash between our regulatory structure, which has been known as the best in the world, the clash of that with different nations, different entities, different approaches to regulation and so forth, and the ability of US-based firms to deal anywhere and to go, if they want to a place of less regulation. The inadequacy in that area is tremendous. Enough of the horror story. What do we do about it? What's going to be the outcome? Well, it's going to depend, in my view, on a massive shift. First of all, in the regulatory structure. We are going to have to redesign our regulatory institutions to envision coverage of the new world of finance. But it won't be enough to do that here. We're going to have to somehow coax the rest of the world to come up with regulatory structures that are coincident and with ours. And that is going to be some tough problem. For any of you in the room who have dealt with sovereign nations and with foreign regulators and with different mores, you know how different their ideas and attitudes are. So when we have the 20 nations meet here a week ago without the upcoming President of the United States attending, really not much could be accomplished. It was at 70,000 feet, sort of handshakes and agreements to cooperate, but when you get down to the short strokes in having regulatory mechanisms that are complementary and so forth, it's a tough thing. We have pretty good enforcement relationships with foreign entities, with foreign countries. We exchange information, so forth and so on, but we have very different attitudes toward accounting, international financial reporting standards, different GAAP, different attitudes toward free markets. So there's a lot of built-in difficulty here, but it's going to have to be done. And I suspect that the only way it's going to be done is from the top down with codes of ethics and so forth. But in terms of hard and fast rules down at the operating level to achieve comparability, it's going to be very hard to achieve. Now, I think that lest I leave you all with a very bearish, dark cloud, I think that we're going to have a major shift from consumption to savings. I mean, zero savings rate. We're being financed by the Chinese and others who are buying our bonds. So that can go on just so long. I mentioned earlier that we're on the cusp of a trade-off, as silly as this sounds, between deflation and inflation. Because in fact, we basically are beginning to flood the market with instruments, federal instruments, that will diminish the value of the dollar. Now, it hasn't happened yet because the dollar is a highly liquid store for everybody in the world. People are willing to buy dollars. So, and they're doing it, even though they're getting like 1% or less on that money. But once the impact of, when things settle down, the impact of the inflationary pressures that are being built in with this money that I'm talking about that we owe, I suspect that we're going to see a resurgence of inflation. So either we're going to go potentially into a deep recession, or we're going to be in an inflationary environment, unless we do a couple of things. And I think that I would say that what we really need is leadership. Leadership in a lot of areas. Leadership, number one, in the executive branch of the country. And we're all, we've got a new president coming down the pike. I won't get into the politics of it. We have a very intelligent new president. I had the opportunity of attending a couple of meetings with him just 2 weeks ago, and I assure everyone in the room that he not only speaks articulate English, but he's a listener and he's on top of the problems. That doesn't mean that he has the solution, but that means he understands what he's facing. So we're going to need leadership from President-elect Obama. We're going to need leadership from our legislative bodies. I mean, we've got to somehow create a massive shift in the contentious and partisan politics of Congress. I mean, it's just unbelievable that we have bickered as we have in the situation that we're in right now. Somebody has got to show leadership in terms of knocking down those partisan walls. And of course, business, and I suspect all of us in this room, whether we're in business or not, have got to show some individual leadership here in terms of the way our businesses and institutions are run. I think that I read a quote the other night, which I think is particularly pertinent at this point, and that is that we're going to need tremendous cooperation. And I'm referring now to what Ben Franklin said a long time ago. He said that we must all hang together, or we will hang separately. And I believe that is such a truth now in terms of the situation we're in now. So, thanks very much. I'd be delighted to.
Should we bail out the big three automakers?
Where was he? SEC?
Yeah.
What?
SEC.
The SEC.
Yeah.
You.
You're putting me on the spot.
Yes.
Because I have.
Can't hear you.
I'm not talking to this. Am I turned off? Hello. Yeah, I'm back on this one. It made it a practice not to comment on what's going on at the SEC. However, I can tell you what went on in the SEC when I was there, at least what we attempted to do. We attempted to register hedge funds. We found it incredible that the $1.7 billion worth of funds were in entities that had no regulation at all. We sought to resolve the conflict of interest in the mutual fund industry as between mutual fund chairman of a management company being also the chairman of the funds that are being run. The conflict of interest having a fiduciary responsibility to two different sets of shareholders. We propose that the chairman of the mutual fund company be an independent chairman. We had lots of static on some of those things we tried to get through. We did a whole lot of other stuff. The most important thing we did is we established a risk control function in the SEC. And what I mean by that is we established a department whose job it was to look over the hill and around the corner and try and assess problems coming down the pipe before they happen. The SEC ends up at the scene of the accident to mop up and has no preventative mechanism. I'm sorry to say, and that program was built up and so forth, and it was eliminated. In the current SEC. The current SEC changed a number of things that I felt were counterproductive in terms of a predilection toward free markets and a predilection toward not enforcing the laws. They changed the structure within the SEC so that what used to be the staff's role in enforcement of beginning the investigation and so forth, they are now allowed now to start an investigation, even begin to, without getting permission from the commission. And I assure you that the commission can't have the faintest idea what the issues are at that level. I mean, it depends upon the staff doing their professional thing, and you'll always have the opportunity to turn that down when they bring a decision that they want from you. But anyway, there are a number of things that I think are unfortunate. Having said that, it's a tough time, and particularly tough given the sort of overlapping responsibilities of the Fed and the SEC and the CFTC.
And the big three? The big three. Question about bailing out the big three. Automotive. The big three automotive. Auto industry, should the government bail them out? Or should they go into bankruptcy?
Well, the automobile industry, my own opinion is that it's a dead horse galloping at a slower pace on a campus, that any attempt to change the industry by putting money in it is going to be money down the drain, is pushing off the problem. That there ought to be some sort of a prepackaged bankruptcy. American public says bankruptcy. That's horrible. We all know that it's perhaps the only way of abrogating the contracts, getting out of labor contracts, doing all the things that will destroy the industry. And it doesn't mean that the company will not open up for business the day after it's declared bankruptcy. However, the concept of General Motors going bankrupt in the environment that we have now is a serious thing to evaluate, because clearly that's not going to turn confidence around, just the other way. Yeah.
I know you said you don't comment on sort of current SEC policy matters, but maybe help us understand the thinking.
Talk so the other people can hear.
Maybe help us understand some of the rationale behind doing away with the uptick rule. I guess I work in an industry where that's a key tenet of our business, and I think most of the people that I work with would agree that it was a bad decision to abandon the uptick rule. And I guess we're trying to reconcile how that happened.
For those of you that are not into the arcaneness of the uptick rule, one of the remedies back in 1929 that was put into the stock market was that you could not sell a stock short unless did it on an uptick. In other words, you could go in and sell it short, but your next sale had to be an uptick from where that first short went. That meant that you couldn't come in and just drive a stock down until you got put your short position in. So the uptick rule worked for a number of years and prevented that kind of manipulation. It was eliminated. There was a lot of research done at the SEC as to whether it was viable in an environment in which stocks no longer trade in eighths and quarters and trade at decimals, and an uptick rule is hard to do, almost impossible in that environment. My own feeling was that the analysis that was done was okay for a good market when the analysis was done, not okay for the kind of market that we're in right now. I would think that we ought to have, reinstate the uptick rule, I'll tell you directly. I think we can reinstate it. We don't have to do it at an eighth or a quarter, we can do it at a half a point. It is sort of a circuit breaker, if you will, on an individual stock, and it has a real place in this thing. I think the elimination of short selling, on the other hand, was and is a mistake. I think short selling is part and parcel of finding the right price for things. And I think when you unilaterally eliminate short sales, you cause tremendous problems for people who have investment positions that are hedged and they can't get out of them. And then that's cost a lot of people a lot of money because they've been stuck in positions that they needed to short in order to complete the trade. I don't mean to get too technical. Yeah. Oh, I'm sorry. I thought, yeah.
You'd asked.
No, I thought you had your hand up. I'm sorry.
Yes, I did.
Okay.
Two things. I'd like you to comment on two things. One, if the subprime residential mortgages crisis caused, why don't they simply put a 3 to 5 year moratorium on them and roll back the originally debt service to the original APR rate for those who are solvent, and then phase in the higher reserve requirement of the banks and the mark to market over 5 years. That would give the economy time to rehabilitate itself, stabilize the real estate market, and sort of neutralize the credit default swaps. Also, you have a world liquidity crisis. What about the possibility of having the UN, through the UN, the IMF, the World Bank, the OECD, restrict sovereign funds spent offshore only to finance industry in the global economy, and those loans would be guaranteed by the country where those corporations are located?
Well, but look, I mean, let me say this. I don't think we're going to get out of the mess we're in until we solve the housing problem. We've started to get the liquidity problem going, but until we turn the housing situation around and stabilize it, we're in the soup. Now, and the government has decided not to do that yet. There are lots of ways to begin to do that. One of the first things that I would do if I were king would be to go into the person who has this toxic mortgage and evaluate their ability to pay under the traditional standards. And if, on my example I was using, if they have the ability to pay, they will give them a government guaranteed 30-year mortgage with an interest rate that represent the traditional 1/3 of their income. And that would cause, so that would solve part of it, and that would cause a loss on that price. The price would be the deflated price of his home was. And then there are lots of different ways of addressing who shares that, because there are two mistakes made. I mean, the purchaser of the mortgage made a mistake, the lender made a mistake, the government made a mistake. There are a lot of people who are responsible for that loss. And I suspect that there are ways of creating a sharing in the upside of that when it turns around. In other words, the government puts the money in, maybe the government gets a piece. You know, we don't have any equity ownership. We have second margins, we don't have equity ownership in house. There are a lot of different ways of solving it, but we seem to be stuck now on we haven't done anything yet. And it's complex. Yeah.
What about the sovereign funds?
Yeah, you've had your time, yeah.
The sovereign funds, you know,
I understand that one of the problems with Chapter 11 is that the people who've taken it can't get loans, so they really go down the drain. Wouldn't that be a problem for General Motors?
Well, look, bankruptcy is like one complicated subject. The more I've been exposed to the experts in this, the more I begin to understand the complexity of Chapter 11 filing. On the other hand, there are, I believe, ways of doing it, whether it's a pre-packaged, ways of settling all the people that interface with General Motors, suppliers, et cetera, that would basically get at the aggregation of the contracts, but would not have some of the drawbacks of filing. And it's, I don't mean to duck, it's just very complicated, but you know, it's easy for me to stand up here and say, they ought to go bankrupt, you know, and it's their fault, and all that sort of stuff. But I do worry about the impact, the psychological impact on the country, and I'm absolutely convinced that any money going to those automotive companies without the strictest of terms is money thrown away. Yes?
Two thoughts. Is there any effort right now to put any regulation on CEO salaries with also clawback provisions on a more universal basis? And my second question is, I've read there's 55 trillion of credit default swaps out there. No one's talking about how to possibly deal with that. So is there anything happening to help that situation when that shoe falls?
Yeah. Well, on the credit default swaps, the $55 or $57 trillion figure is the notional value. You know, there's a lot of cancellation in there, so when you get down to it, it's probably closer to $1 trillion, which is not small change, but it's a lot less than that number indicates. In terms of executive salaries, again, it's a subject that everybody's been wrestling with. The regulators have been wrestling with it. There's been some movement in terms of non-binding resolutions about salaries and English system of the shareholders showing their displeasure with salary. I'll stick my neck out now and say that I believe that people ought to be really paid if they do really a sensational job. And if they really built a great company over a number of years, they should be paid very well. I also think that somebody who slips into an executive position for 3 or 4 years, inherits a company, sits on top of it, doesn't improve market share, and walks away with a golden parachute and all sorts of goodies, that needs to be stopped. And that's part of everybody here that's involved in that taking this seriously and doing something about it. Yes?
Just looking forward, we're going through this massive deleveraging. We're going through a very massive deleveraging process worldwide, I think. And one of the implications of that is that companies won't be able to be as profitable anymore because they used leverage very substantially to make these profits. And that means a whole new world in terms of finance, Wall Street, and even Main Street businesses. There's going to be a lot less leverage available, and we have to learn it. We're going into a new type of economy. Could you comment on that?
Well, that's true. I mean, there's a lot of leverage out there, a lot of personal leverage in the form of credit cards. a lot of corporate leverage, a lot of leverage inside some of the hedge funds that have leveraged up their positions, et cetera, et cetera. I think we're seeing the effect of deleveraging now in the marketplace in terms of some of the hedge funds, dumping stock in terms of margin calls and so forth. I think there's going to have to be some way to renegotiate the terms of some of this debt. Now that's a real difficult political problem because the sanctity of the mortgage is something that the mortgage industry has had for years. The idea that you can change the terms after it's out there, the mortgage industry would say, "Oh, we'll never give out another mortgage again. We can't depend upon the terms." So, but we're going to have some attempt to adjust that leverage and adjust the terms of it, I think. I'll let you all go. I'll stop. And
Bill, thank you very much for one positive question that might elicit a positive response, which is, will the financial system come out of this stronger, in your estimation? It doesn't sound very hopeful.
No, the question is when and at what level. And again, not being Pollyannish, I suspect that I'm one of the few people in this room that was alive when this country faced an even greater problem, which was World War II. And I remember the coming together of the country around a big problem. And that's the kind of thing we need. And if we can get that going and get the spirit going in all the different groups, we're going to come out of it for sure.
Thank you very much. Thank you, PricewaterhouseCoopers. There'll be a section upstairs.